This is a first pass on what people are calling Trumponomics. A lot of it is very ill-defined. None of this is in legislation. None of this is passed. So making a whole host of assumptions, probably at least half of them will be wrong. Hopefully they'll offset each other, so it'll come out close to right, but we'll find out. And we're going to characterize this as we're moving from a period from a very reckless monetary policy, and we'll define that as a zero interest rate policy for the past 6 or 7 years, continued quantitative easing in the face of a modestly growing economy and a near fully employed economy. It doesn't make sense to have the kind of emergency measures monetary policy that we had in 2008 and 2009. And and it also created all kinds of distortions in the bond market and messed up the funding of pension funds throughout the United States and throughout the world. And we're moving to a reckless fiscal policy, and by that we mean is we're going to enter into an era of very, very high deficits. And the high deficits are coming not when the economy is in big-time recession, when you're supposed to run some deficits. It's when the economy is at or near full employment. So I will call that a reckless fiscal policy. Well, the election is over, and here are sort of the cast of characters. As my wife couldn't wait until the election was over, and then it was over, and then she wished it wasn't over, but and stuff like that. She just couldn't wait. She turned off the television the last 2 weeks of the campaign and stuff like that. But the election is over, and we have a new president. All right. The main themes is we think the post-election rise in stock prices and bond yields, and also the dollar, is reflecting what economists call a regime change. We're going into a different world. Fiscal policy is going to dominate monetary policy. We're going to have very big tax cuts along with higher defense and infrastructure spending, and that will give us a $1 trillion deficit in 2018, and temporarily faster growth with higher inflation and interest rates. The economy has less room to run now because we're at 4.6% unemployment. We thought we wouldn't get to 4.6 until the spring. We got there last month. My guess is the next tick will be an uptick because we think that was just too much of a move down from 4.9 to 4.6. But we're at or very, very close to what economists would call full employment. The elements that we define of Trumponomics is we have $500 billion a year in tax cuts, $300 billion on the personal side, $200 billion on the corporate side. We think that'll take effect in the third quarter for modeling purposes. We'll have increased defense and infrastructure spending. We have cuts in Medicaid or the Affordable Care Act. We have a relaxed regulatory environment. And we're assuming here modest changes in trade and immigration policy. Now, if the changes are much more aggressive, then the forecast probably would be downwardly revised. So we think there's more talk on immigration and more talk on trade as opposed to what will actually take place. Okay, that's important proviso. If we go into a trade war with China, this forecast would be revised down. If there's mass deportations, the forecast would be revised down. Paul Ryan said there wasn't going to be a deportation force. Congress wasn't going to approve it. So we're assuming the changes in immigration policy are going to be modest as opposed to radical. And the sense is it's not going to affect our numbers all that much. All right, this is what happened to the stock market. The stock market immediately, the first big rise was the day of the election where people thought that was the Clinton rally, but maybe the market was sensing it was a Trump rally the first day. That was election day, and then the market has continued to run, and stocks are up around 4 or 5% since election day. Next thing that happened is this is the 10-year Treasury. 10-year Treasury goes in round numbers from 1 3/4 to 2.40 in a month. Huge, huge move in the 10-year Treasury. To put that in mortgage market terms, mortgage interest rates from mid-October have gone from 3.5 to roughly 4 1/4 for the 30-year fixed rate mortgage. So this is also a big deal. As a point of fact is the global bond market, which is like very, very huge right now, the dollar losses in the global bond market in November was over about $1.2 trillion, which was the biggest single monthly loss in the history of the global bond market. So something big has happened, and then next is, in response to that, the dollar soars. Now, why does the stock market go up? The stock market is projecting higher real growth and more pricing power for corporations. The bond market is saying there's going to be more inflation, and the era of shortages of bonds are over because of people worried there's a shortage of quality fixed income instruments. Well, the Donald is going to, if you want bonds, we got a lot of bonds to sell you, and there'll be a lot of bonds in the market. And the dollar is going up because the United States is perceived to be a better place to put capital, invest money. We're going to have higher interest rates and presumably a higher after-tax return on investment because corporate taxes will be lower. So all of this hangs together. We think the markets are right in terms of direction. We don't know the extent of how far this will go. That's the big question in our mind, but we think we're in a different regime. The federal deficit is forecast, though, the federal deficit was going up anyway, but we have it going up to over $1 trillion in 2018. And if you do simple arithmetic, if you start out at $500 billion and you cut taxes by $500 billion, you get to $1 trillion. Now, there's a lot of other things going on, but in the very simple way of looking at it, that's how the deficit doubles. We do not have huge infrastructure spending, and I'll get into that in a little bit. All right. The interest rates in this environment is we think the Fed will raise rates next week. We don't think that's a bold forecast because that's what the market is saying. We said in September, we said they would increase in December. They're increasing, they're going to increase next week. We think there'll be maybe 4 hikes next year, which is much more than what the market has, and more hikes the following year. And people say, why are we going to get all these hikes? Well, in part is the economic picture is going to be different. And also the personality on the Federal Reserve Board is going to change. There are 2 vacancies right now on the Federal Reserve Board in Washington right now. Donald Trump is going to appoint 2 new people, probably will be more hawkish than the existing board. And Janet Yellen's term as chairman expires in January 2018, and she will probably leave at that time. So we're going to have a whole new Federal Reserve Board. So whatever we've been used to in the past 5 or 6 years, from the Bernanke Fed to the Yellen Fed, that by early next year will have a complete 180 change in the personality of the board. And my guess is that will be more hawkish than the board we've had. So that's part of the reason why we have more rate hikes. We also think long-term rates will go up. Now, when we did this forecast, we thought we'd end the year at 2.25. We're 2.40 right now on the 10-year. We think the 10-year could be 3% at the end of next year, into 17, and 4% at the end of 18. Now, markets move faster than forecasts, so we could be at 3%. If you have the recent rate, you get one more move up in the leg up in bond yields, we could be at 3% at the end of January. I don't think that's going to happen, but the markets tend to move much faster than what modeling, any kind of economic modeling would suggest. So we don't think, we're way above consensus, but we don't think we're really being all that aggressive given the backdrop that we're facing. All right, next thing is we're going to get, with all the stimulus, we're going to get a short uptick in GDP growth. We're going to even get a 4% quarter in the third quarter, and we're going to have, roughly we'll have 4 quarters averaging over 3% real growth, and then it's going to go back down to 2%. Ed's number, we're going to go back down to the 2%. If you want to say we're going to 3% growth or 3 to 4% growth, you have to have a productivity miracle. And that's sort of a faith-based kind of thing. Now, the Trump people would suggest is we're going to get that from 2 sources. We're going to get a lot more investment from the tax cuts. And they also suggest the regulatory reform that's coming will radically increase productivity. Example, Goldman Sachs hired like 4,000 people in the past several years, all of them in compliance. So therefore, so they don't need all that compliance. If Dodd-Frank will be roll back a lot, all of a sudden you don't need all these compliance people. They don't add a scintilla to productivity in the short run, at least the way we measure it. So you could argue that that's what they would argue. We're not arguing that. We're going to have wait and see if the regulatory relief, and we don't know what exactly it will be, what that will actually mean for productivity. So we're assuming no productivity miracle, and we're back into Ed's 2% corridor, although we get a quick rise between mid-17 and mid-18. All right, employment growth will remain solid. We're not going to get 200,000 a month. We'll probably get 140,000 next year, 120,000 the year after, because we're at full employment. We have unemployment falling to 4.5%. Now, this was done before the 4.6% print, so that's not, that's not an exciting forecast. But we think we'll be in a steady state of around 4.5% unemployment for the next 2 years. And we also think in this environment, we're going to get 4% wage increases. Now, the compensation series here, I don't think is reflecting what's really going on in the labor market, because anecdotally, it looks like wages are going up much faster than what the data suggests. And we think we'll be at 4% wage increases in 17 and 18. And that'll be underlying pressure on the system. It'll also mean real wage gains, because if we have inflation maybe at 2.5%, we'll have wages at 4%, so there'll be some real wage gains. And this is our inflation forecast. We're over 2% on core CPI, which is the yellow line. We'll hit 3% on regular headline CPI as oil prices begin to roll through, and inflation is going to stay at 2.5 to 3% from mid-2017 on a year-over-year basis. So this is above the Fed's target. We're going to have unemployment at full employment. We're going to have inflation noted not 0.1% above 2%, but in the 2.5 to 3 range. And that's part of our argument why we're going to see more Fed tightening. So it'll be a change in the composition of the board and the reality of a fully employed economy, trillion-dollar deficits, more inflation. You're going to get a more aggressive. Fed. I couldn't resist. I had my hero Clint Eastwood here, because we have three things on the good and the bad and the ugly of the program. The good is consumption, equipment, and defense. The bad is housing. And contrary to what the Trump people have been saying, the bad is going to be on the trade side, on the economy. Here's real consumption. The tax cuts are going to power consumption growth, and we're going to have real consumption at 3% next year and close to 4% in 2018, because if you rain all those tax cuts on the consumer, a lot of that is going to get spent, and we're going to get more. The consumption will be much stronger. In fact, will be highest since the recovery began. Personal savings rate's going to go up with it, because the bulk of the tax cuts are going to high-income individuals, and so therefore the savings rate is going to rise from about 5.5% to about 7.5%, so people save more money. And this is personal saving. All we're doing is shifting. The government is going to have the deficit, and people are going to have consumer balance sheet's going to get better while the government balance sheet gets worse. That's the transfer that's going on. Equipment spending, we have a rebound in equipment spending. It was negative this year. We have an uptick next year, and then we have a further uptick in 2018. If we're wrong here, my guess this is going to be higher. Factory orders came in. The recent data is coming in much stronger. We don't have a program yet. So if we're wrong here, if we're wrong on equipment, I think the number would end up in real life being higher rather than what we're forecasting here. So that's sort of an upside risk. I'd call that an upside risk to the forecast. And defense spending, after a 6-year decline, will have a modest increase this year and a very big increase next year. Now, I know President-elect Trump said he didn't like paying $4 billion for 2 Air Force Ones today, and there's a thing on waste and defense spending, front page article in the Washington Post. But if you want to increase the number of Marine divisions, you want to increase the size of the Navy, and you want to fix all the airplanes that are sort of breaking down, and defense spending is going to go up a lot. We also had, by the way, defense spending going up. We were $20 billion above our baseline from last September. We had defense spending going up. If there was a Clinton administration, we'd have defense spending going up under a Hillary Clinton administration as well, more under Trump. So we have a 3% increase in real defense spending next year, in 2018. Okay, housing is going to have a problem. And that's just the rise in mortgage rates is much quicker. Our sense is that instead of going to 1,400,000 starts a year, we may top out at 1,250,000 because of the rise in rates. We could be wrong. We used to think the consumer would be able to take it, but we were surprised when we had 3.5% 30-year mortgage rates. We weren't at 1,300,000, 1,400,000 already, so we're more concerned that housing may not be as strong as we had previously thought. So housing, it'll basically flatline from roughly where we are right now in starts, and multifamilies of the 1,200,000 would be about 400,000+, and singles would be about 800,000+ for the mix. Now, the ugly is if the dollar goes up, import prices go down. right? Higher dollar, cheaper imports. And the other thing that happens is with a big tax cut, we have a consumption boom. A lot of the stuff, what we spend money on, are imports. So we have an income effect coming from the tax cuts, and we have a price effect coming from the high dollar. So what it means is imports are going to grow, and all the talk about Trump with tariffs this and tariffs that, the natural bias of the economy in the world we envision is to suck in more imports. The same thing happened in the early 80s with the Reagan tax cuts and the rise in the dollar. So this is nothing new. We saw this in 1981, 2, and 3. We've seen this movie before. So our sense is, even though there may be some trade negotiations with Mexico, trade negotiations with China, is the bias in the economy is to import more stuff coming from the income effect of lower taxes and the price effect of the higher dollar. And it also means is that imports are going to stall. And part of it is the higher dollar makes our exports much more expensive. So that's one issue. And the other thing is, if we're going to have trade issues with trading partners are going to say, well, maybe we shouldn't do as much business with the United States. So we deliberately went into our model and we lowered food exports, because that's a pressure point politically because of all the congressmen from farm states and senators from farm states. And we lowered aircraft exports because it's highly visible and it's high dollar commodity. Now, we may be wrong on that, but we deliberately went into the model and reduced exports, food and aircraft exports, just to deal with as a potential trade risk in the thing. If that doesn't happen, then the exports will grow. But that's one of the assumptions we baked into the model, is Boeing will sell fewer airplanes, and California growers and Midwest growers will sell less agricultural commodities to the rest of the world. The big growth in the GDP in the third quarter happened to be like 6/10 of the growth in GDP in the third quarter of the 3% we got came from a surge in soybean exports. That was sort of like a one-off kind of thing to China. So who knew? But we shipped a lot of soybeans in August. All right, infrastructure spending is really hard to ramp up. The Trump plan calls for private tax credits, all right, and if you do certain kinds of infrastructure spending, you'll get a big tax credit, and he has $137 billion earmarked for that in his plan. And then with those tax credits, you get public-private partnerships, and you build things. The problem is with private tax credits, you need a revenue stream. Fixing all the potholes in Los Angeles does not generate a revenue stream. Fixing some of the water system, the leaky pipes, doesn't generate a revenue stream. So a lot of the maintenance expenditures, which is really the bulk of what we need in infrastructure, is not amenable to tax credit kind of financing. If you want to build a new terminal at LAX, you could do that with a tax credit private-public partnership, but you need a revenue stream associated with it. So we're assuming a traditional kind of infrastructure program, not a tax credit plan. You may get some of that, but we don't think that's going to be a big deal. The other thing is, as President Obama found out back in 2009, there are very few shovel-ready projects out there. And if you want to get the spending to happen quickly, environmental reviews have to be waived or fast-tracked. And the Davis-Bacon Act rules, which sets prevailing wages, which meaning union wages, it takes about a year to put in these Davis-Bacon rules into place. So any project, you got to wait a year just to get the Davis-Bacon rules put in place to get something started. And with EIRs, that could take 3 years, 5 years, 10 years, 12 years, who knows, on that. And not only is there federal EIR rules, there are state EIR rules. So if California doesn't want to waive its EIR rules, it's going to go to the back of the bus. It's not going to get the money. Because Trump wants to see the infrastructure spending. He made a big deal out of the campaign, and my guess is they're going to want to put out the dollars, so the states that are most cooperative with them, they're going to get first dibs at all the infrastructure money. So our sense is this is going to take a while. It's going to take a while to ramp up, and we'll see if the Democrats in the Congress will go along with waiving Davis-Bacon, big union constituency, waiving EIRs, big environmental constituency. It'll be hard. It's sort of hard to put together. If they don't waive them, you'll have it, but we'll have what we had with the 2009 stimulus. It's going to take forever to see the money get spent. So they passed the infrastructure stimulus in 2009. We really didn't see the spending until 11 or 12. So that's one of the issues. All right, so to conclude, we're going from a reckless monetary policy, the goodbye zero rates. We're going to have a reckless fiscal policy with very, very big tax cuts on a fully employed economy, $1 trillion deficit, We're going to have a temporary pickup in growth. We're going to have a pickup in inflation and interest rates. And the risks are, we would see, is if the administration is more aggressive on trade and immigration than what we're assuming. So those would be the risks. So I would summarize is, if you thought a real Trump partisan would say this is really bearish, because they would think the economy could do a lot better. For those people who thought Trump would come in and the world would come to an end, this is a lot better than the world coming to an end. Thank you very much.